Okay, so let's dive right in. Inflation. It's the word on everyone's minds, right? It
Yeah.
seems like everything is getting more expensive by the day.
Yeah, it's definitely a hot topic, and for good reason. Persistent inflation is a real challenge, and it's something that the Federal Reserve, the folks who guide our economy, are watching very closely.
And speaking of keeping a close eye on things, we're all waiting with bated breath for the December Consumer Price Index report, that's CPI. It's a major indicator of whether inflation is easing up or if we're in for another round of price hikes.
This December CPI report, you could think of it like a health checkup for the economy. It gives us a snapshot of how deeply embedded inflation really is.
So what are the experts saying? What can we expect from this report?
Well, economists are projecting headline inflation to hit about 2.9%, which would be up from November's 2.7%.
Okay, so a noticeable jump then.
Right, and that translates to roughly a 0.4% monthly increase in the prices we're all seeing at the grocery store, the gas pump, you name it.
And it's not just about those overall numbers, right? We need to look beyond the headlines, dig a little deeper.
Absolutely. We've got to look at what's called core inflation, which strips out those volatile food and gas prices.
Because those can fluctuate a lot, depending on all sorts of factors.
Exactly. So core inflation is expected to hold steady at about 3.3%. But here's the catch. Some prices are just stubbornly refusing to go down.
Oh, I've noticed that. It feels like some things just keep getting pricier no matter what.
Right. We're seeing this stickiness, as economists call it, in areas like housing, medical care, and services in general. And that's not just a random blip. It's a sign of some broader economic trends at play.
So that's where the Fed comes in. They're the ones trying to keep inflation under control.
Exactly. Remember, the Fed aims for a 2% inflation target, kind of like that Goldilocks zone, not too hot, not too cold.
Why 2%?
Well, it's seen as a sweet spot that encourages stable growth without letting prices spiral out of control. But lately, inflation has been exceeding that target, putting the Fed in a bit of a bind.
A tough spot to be in, for sure. So what's their next move? Do they raise interest rates to cool things down, even if it risks slowing the economy? Or do they hold steady and hope inflation eases on its own?
That's the million-dollar question, isn't it? And to make things even more complicated, we have a new administration coming in, which always throws a wrench into the works.
Yes, the new administration, always a wild card.
And the incoming Trump administration has signaled some pretty big policy changes, tariffs on imports, corporate tax cuts, immigration curbs, all of which could have major economic ripple effects.
And some of those effects could be inflationary, right?
Potentially, yes. So the Fed has to try to predict how all these potential changes might play out. It's like playing chess on a moving board, trying to anticipate every possible outcome.
So with all this uncertainty, what are the markets saying? Any predictions about what the Fed might do?
Well, some analysts think we might see interest rate cuts later this year, maybe around June.
Interesting.
Yeah, but the odds of that happening are only about 40%. There's a lot of debate and disagreement right now.
So not a clear consensus then.
Not at all. You've got some experts, like those at Oxford Economics, who are anticipating 3 rate cuts this year, but they're quick to point out that that number depends heavily on how the labor market performs.
And how's that looking these days?
Well, that's another piece of the puzzle. It's a mixed bag. Then you've got folks like Bank of America, who just recently revised their outlook to 0 rate cuts this year. They're even hinting that a rate hike might be on the table.
Wow, so we've got predictions all over the map. It really makes you wonder how the Fed weighs all these factors, all these different perspectives when making these critical decisions.
It's a complex process. They're looking at a whole constellation of data points, inflation, of course, but also employment numbers, consumer confidence, global economic trends, all of it. And let's not forget the political landscape.
Because politics always plays a role, doesn't it?
Absolutely. The Fed loves stability. They thrive on predictability. But with a new administration known for shaking things up, their job just got a whole lot harder.
It's like trying to steer a ship through a storm while someone's constantly changing the course.
Exactly. And speaking of navigating choppy waters, don't forget to like the video and subscribe to the channel. We appreciate you joining us as we delve into these fascinating and often unpredictable economic currents.
We're all in this together, trying to make sense of it all.
Yeah.
So let's get back to the Fed. Their decision-making process is a bit of a black box, isn't it?
Yeah, it's not always transparent, but what's really interesting is how they try to balance these competing pressures. On one hand, inflation is stubbornly above their target. On the other hand, raising rates too aggressively could stifle economic growth. It's a delicate dance, and the music is constantly changing.
And everyone's waiting to see what steps they'll take next. So let's break it down for our listeners. What happens if the Fed decides to raise interest rates? What does that actually mean for us, for everyday people?
Well, the most immediate impact is that borrowing money gets more expensive. Think about those big ticket items: mortgages, car loans, even credit card debt. Those monthly payments could start creeping up, which can put a real strain on household budgets.
And it's not just individuals who feel the pinch, right? Businesses also face higher borrowing costs when rates go up.
Exactly. It makes it more expensive for companies to expand, invest in new projects, hire more workers. It can really put a damper on economic activity overall.
So it's a ripple effect that goes far beyond those initial interest rate hikes.
Oh, absolutely. It impacts everything. Now, on the other side of the coin, if the Fed keeps interest rates low, well, that can create a more favorable environment for both consumers and businesses.
Makes sense. Lower rates mean it's cheaper to borrow money, so people are more likely to spend and invest.
Right. Lower borrowing costs can encourage folks to buy homes, cars, start new ventures. All of that can really fuel economic growth.
It sounds like a win-win.
Yeah.
But I'm guessing there are downsides too, right? There's no such thing as a free lunch.
Well, there's always a trade-off. Holding rates too low for too long can actually lead to, you guessed it, more inflation. And that can really hurt people on fixed incomes, like retirees.
Because their income isn't increasing, but the cost of everything is.
Exactly. As prices rise faster than their incomes, their purchasing power shrinks. It's a tough situation.
It's like being on a treadmill that's constantly speeding up. You're working harder and harder, but you're not getting anywhere.
A very apt analogy. So the Fed has to walk this tightrope, trying to find that balance between stimulating growth and keeping inflation under control.
It sounds like a real juggling act with a lot of moving parts.
It is. There's no magic formula, no crystal ball that tells them exactly what to do.
They can't just flip a switch and make everything perfect.
Not quite. So they rely on a lot of data, a lot of analysis, and even a bit of intuition to guide their decisions.
And the December CPI report, the one we talked about earlier, that's a crucial piece of the puzzle for them.
It is. But it's just one data point among many. They're also looking at the labor market, global economic conditions, and of course, the actions of this new administration.
Because, as we've said, politics always plays a role.
Always. And speaking of unpredictability, it's worth remembering that economic forecasting is not a perfect science.
It's more of an art than a science sometimes.
You could say that. There are always unforeseen events, unexpected shifts that can throw even the most careful predictions off course.
So, how can we make sense of all this? What does it mean for us regular folks trying to navigate this complex economic landscape?
Well, it's not about panicking, it's about being informed. It's about being proactive and understanding the forces at play.
Knowledge is power, as they say.
Exactly. And the more you know, the better equipped you are to make informed decisions, especially in times of uncertainty.
So let's play out some scenarios. Let's say inflation continues to rise, even though the Fed is trying to rein it in. What happens then?
Well, in that case, we might see the Fed taking a more aggressive stance. They might start raising interest rates more frequently, more substantially than they've been suggesting.
So those rate hikes we discussed, they could become a more regular occurrence.
Potentially, yes. And as we've talked about, that would have consequences. Higher interest rates can make it more expensive to borrow money, which can slow down spending, slow down investment, and potentially even slow down economic growth.
It's that trade-off again, trying to find that sweet spot.
Exactly. It's a delicate balancing act. But what if those efforts aren't enough? What if inflation just keeps chugging along, refusing to budge despite the Fed's best efforts?
That's a scary thought. What happens then?
Well, then we enter the dreaded territory of stagflation.
Stagflation. I've heard that word thrown around, but I'm not sure I fully understand what it means.
It's basically a toxic combination of stagnant economic growth and persistent inflation. It's like being stuck in quicksand. The economy isn't growing, but prices keep rising, creating a real sense of malaise, a feeling of being trapped.
And I'm guessing it's not easy to get out of that situation.
Not at all. Stagflation is really tough to tackle because the usual policy tools like interest rate adjustments don't always work effectively in that environment. It requires a more nuanced approach, a careful calibration of policies to address both the stagnant growth and the rising prices.
Sounds complicated.
It is. And on top of the economic challenges, there's also the psychological impact of persistent inflation to consider. When people see prices constantly creeping upward, it can really erode their confidence in the economy. They might start delaying big purchases, holding onto their cash, which can further dampen economic activity.
Like a self-fulfilling prophecy.
Right. Fear and uncertainty start to drive economic decisions, and it can create a downward spiral. But even in the face of these challenges, there are always opportunities. Informed investors, savvy consumers, they can find ways to not just survive, but thrive, even in the most challenging economic conditions.
It's about being adaptable.
Exactly. It's about being resourceful, about making smart choices. So let's shift gears for a bit and talk about what individuals can do to navigate these potentially turbulent financial waters.
So much to think about. Where do we even begin? When it feels like the economic ground is constantly constantly shifting. What are some concrete steps we can take to protect ourselves?
Well, I think one of the most fundamental principles of building financial resilience is diversification.
Don't put all your eggs in one basket.
Exactly. Spread your investments across different asset classes, stocks, bonds, real estate, even things like commodities.
So it's all about managing risk, making sure you're not too exposed to any one particular area.
Precisely. And in times of inflation, it's also worth looking into what are called inflation-protected securities.
Okay, inflation-protected securities. What are those?
Well, they're investments that are designed to keep pace with rising prices. So even when the cost of, everything is going up, they help preserve your purchasing power.
That sounds interesting. But I have to admit, the world of investing can feel pretty overwhelming, especially if you're not a financial expert.
I hear you. It can definitely be a lot to navigate. And that's where a good financial advisor can be a huge help.
Okay, so finding a professional to guide you through it all.
Right. A good advisor can help you create a strategy that's tailored to your specific needs, your risk tolerance, your financial goals. They can take a lot of the guesswork out of it and provide some personalized guidance.
It's like having a personal trainer for your finances.
Exactly. Someone to help you stay on track and make smart decisions. But beyond investments, there are also things you can do in your everyday life to be more mindful of your spending when inflation is, eating away at your budget.
Oh yeah, those everyday habits, they definitely add up.
They do. So take a look at your spending patterns. See if there are areas where you can cut back without, making major sacrifices to your lifestyle. Maybe you can try some different brands, shop around for better deals, even consider doing some DIY projects.
Being a savvy consumer looking for ways to save.
Exactly. And, don't be afraid to negotiate.
Right?
Oh, yeah. Whether it's your cable bill, a car repair, even that new phone you've been wanting, it never hurts to ask for a better price or explore different options.
You never know until you ask, right?
That's right. In a world where prices are always going up, every little bit you can save makes a difference.
Yes, it all adds up. So to bring it all together, we've covered a lot of ground today. That upcoming CPI report, the Fed's balancing act, those potential impacts of a new administration, and even some practical tips for navigating these kind of turbulent economic waters.
It's a lot to take in.
It is.
Yeah.
But I think the key takeaway here is that even though we can't control what's happening on that macroeconomic level, those big forces shaping the economy, we can control how we respond to them.
That's such an important point.
By staying informed, being proactive, making smart choices, we can weather those economic storms, whatever they might bring.
Absolutely. It's about empowerment. It's about taking control of your own financial well-being, even when things feel uncertain.
I love that. So thanks for joining us on this deep dive into inflation, interest rates, and everything in between. It's been a fascinating conversation.
It has. And until next time, stay curious, stay engaged, and keep those brains firing.